The U.S. markets are closed for the weekend, but the final session for Eos Energy Enterprises, ticker EOSE, was nothing short of explosive. The stock finished Friday, November 7, 2025, at $18.26 per share. That was a staggering gain of 19.42%, or $2.97 in a single day. The stock traded in a massive range from $14.20 all the way to $18.34, closing just shy of a new 52-week high on truly immense volume. We saw 41.8 million shares change hands, which absolutely dwarfs its 30-day average volume of 24.3 million. Now here is the immediate critical disconnect, the insight you won't get from a simple chart. That 19.42% surge, that violent move up, happened just after the company reported its third-quarter earnings. And those earnings, from a headline perspective, were an absolute disaster. This is the core tension you have to understand. The expectation when you see a 19% rally is that the company must have crushed its numbers, raised guidance, and announced a new breakthrough. The reality for Eos is far more complex and, frankly, far more interesting. The market in this case decided to completely ignore the present in favor of a very specific, very powerful future narrative. Let's establish the common ground, what the average investor sees. If you're looking at EOSE on your Robinhood app or through SoFi Invest, you see a stock that has been on a tear, hitting new highs. You see a made-in-America battery company. You read the press release headline that says, "Record quarterly revenue," which is true. Revenue of $30.5 million was a 100% increase compared to the prior quarter and a 35-fold increase from the same period last year. That's the kind of growth that makes people think of the early days of Tesla stock. You see a company tapping into the green energy and AI infrastructure boom, and you see a 19% gain and assume the rocket ship is just getting started. This is the expectation. Now, let's challenge that with the reality, the numbers buried in the report that should have, by all traditional metrics, sent this stock cratering. The consensus expectation was for revenue of $39.62 million. Eos delivered $30.5 million. That is not a beat. That is a significant 23% miss. It gets worse. The EPS forecast was for a loss of 24 cents. The actual reported loss per share was $4.91. That is not a miss. That is a fundamental chasm. And the headline net loss? A staggering $641.4 million. So how on earth does a company miss revenue, miss profit expectations by thousands of %, and post a $641 million loss only to be rewarded with a 19.42% stock surge on massive volume? This is where we separate the noise from the signal. The signal is that the market, from institutional desks running complex models on an interactive broker's platform to high-conviction retail traders, has collectively decided that none of those numbers matter. They have looked at the reality of the present and rejected it. They are trading entirely on the expectation of the future. First, that $641.4 million net loss. This is the key. The company's own report states this was driven primarily by a $572.3 million non-cash impact from the changes in fair value of its warrants and convertible debt. In simple terms, this is an accounting quirk. Because the stock price rose so much during the quarter, the potential liability of these convertible instruments went up, and accounting rules forced them to book that as a massive loss. It's a non-cash charge that punishes the company on paper for its own stock success. The market, it seems, is sophisticated enough to see this, filter out the $572.3 million of accounting noise, and look at the actual operations. Even with that noise filtered, the operations are still bleeding cash. The adjusted EBITDA loss was $57.7 million. But here's why the rally happened. First, despite the Q3 revenue miss, the company reiterated its full-year 2025 revenue guidance of $150 million to $160 million. This tells the market that the miss was a timing issue, a temporary bottleneck, and that the fourth quarter is going to be enormous, implying a Q4 revenue of $70 million or more at the midpoint. The market is betting that the production ramp is finally here. Second, the narrative. The entire bull case for Eos hinges on its technology and its ramp-up. The company is advancing automation at its Turtle Creek facility, targeting an annualized production rate of 2 gigawatt-hours by the end of this year. The market believes they are finally cracking the code on manufacturing at scale. Third, and perhaps most important, is the why. Eos is now inextricably linked to the AI build-out, the same trend that has propelled NVIDIA stock to astronomical levels. The problem with NVIDIA stock's success is that AI data centers require an almost unimaginable amount of power. The grid is not ready. Eos just announced a strategic collaboration with Talen Energy to develop multiple gigawatt-hours of storage capacity specifically to support data centers and AI infrastructure in Pennsylvania. They also signed a 750 megawatt-hour master supply agreement with MN8 Energy, a large renewable operator. This is the new narrative. Eos isn't just a green company anymore. It's a critical infrastructure play for the AI boom. The market is betting that every company building a data center will need a company like Eos to provide reliable, long-duration energy storage. And this is where government validation comes in. The U.S. Department of Energy loan guarantee and the $24 million incentive package from Pennsylvania de-risk the financing for this massive factory expansion. The government is essentially backstopping the Made in America scale-up. So what does Eos Energy actually do? Unlike Apple stock, which sells you a phone, Eos sells massive battery energy storage systems, or BESS. Their core technology, the Eos Z3, is not lithium-ion. This is the whole point. It's a zinc-based aqueous battery. The company's entire pitch is that lithium-ion is great for phones and cars, but flawed for grid-scale storage. It's flammable, relies on scarce critical minerals, often sourced from geopolitically unstable regions, and is best for short-duration power bursts. Eos claims their zinc batteries are non-flammable, built with abundant domestically sourced materials, zinc, water, and carbon, and designed for long-duration discharge of 3 to 12 hours. This is what the grid and what a data center needs, the ability to store massive amounts of energy, from solar or wind or just off-peak grid power, and release it steadily for hours. The Inflation Reduction Act, with its production tax credits for U.S.-made battery components, is a massive tailwind for this specific business model. The institutional activity confirms this is not just a retail phenomenon. As of recent filings, major players like BlackRock and Vanguard are significant holders. Institutional ownership sits at over 52%, meaning that a lot of smart money managing funds in Fidelity brokerage accounts or Schwab Intelligent Portfolios has bought into this long-term story. This provides a floor of support and a base of conviction that you don't find in pure meme stocks. These firms are making a multi-year bet on an online investment thesis. This is not a stock for a simple individual brokerage account looking for quick dividends. This is a venture capital style bet in the public markets. The volume we saw on Friday was a potent mix of new institutional buyers, a short squeeze on bears who bet against the company, and a rush of retail traders on Robinhood and SoFi who are chasing the momentum. This is a battleground stock. Looking ahead, the future outlook is now sharply, violently defined. The bull case, the expectation, is that Q3 was the final painful cash-burning quarter before the real ramp. The bulls believe the automation is coming online, the revenue is about to hockey stick in Q4 and 2026, and the $644.4 million in order backlog, part of a $22.6 billion commercial pipeline, will finally start converting to massive, high-margin sales. The company is guiding for positive gross margins by the first quarter of 2026. If they hit that, and if the AI narrative holds, $18 a share will look comically cheap in hindsight. This is the high-growth story that many people doing self-investing are looking for. But the bear case, the reality of the risks, is just as stark. This company is still deeply, profoundly unprofitable. It is burning cash at a ferocious rate. As of September 30th, it had only $126.8 million in cash. That's not a lot of runway for a company trying to build a massive, capital-intensive manufacturing empire. The execution risk is off the charts. If the automation ramp stumbles, if the Z3 modules have quality control issues, or if that Q4 revenue spike doesn't materialize as guided, this stock will collapse. This is not a safe investment. The competition from lithium-ion, despite its flaws, is entrenched and its costs are falling. Eos has to prove its zinc technology is not just viable, but cheaper and better at mass